Businesses predict and track the depreciation of assets that have longer lives with a depreciation schedule. Let's investigate how depreciation schedules are structured as we build one for the global nomad's purchase of a printer, copier, fax machine. Depreciation schedules contain the date of purchase, so January 1st, 2014 for the printer. The name of the asset, which is printer, copier, fax. The cost of the asset, this printer costs $50,000. Its estimated life, which is 5 years. And its disposal value, if any. In this case, the disposal value will be $1,000. Accountants use a simple formula to determine the depreciation amount. They take the asset's cost, subtract its disposal value to get the total depreciable amount. The printer costs $50,000 minus its $1,000 disposal value, which means that the total depreciable amount will be $49,000. Then, accountants divide the asset's depreciable amount by its estimated life in years. So that $49,000 is divided by 5 years, which equals $9,800, which becomes the yearly depreciation amount for the purchase. The method of dividing the cost evenly over its useful life is called straight-line depreciation. The depreciation schedule is created to show how the asset's value or book value decreases over time. The depreciation schedule shows how much the book value depreciates to a lower year-end book value throughout the year. Each year, the book value on an asset decreases based on its estimated depreciable amount. In 2014, the book value of the printer started at full value but depreciated $9,800, leaving us with a year-end book value of $40,200 by the end of the year. Each year's year-end book value becomes the next year's starting book value. Have you noticed that the book value drops by $9,800 each year as you build this schedule? To complete this schedule, we will track the changes in 2 additional accounts: depreciation expense and accumulated depreciation. Depreciation expense is a temporary account where the cost of the item is deducted each year at the end of the fiscal period. We already figured that the depreciation amount was $9,800, so this amount will be posted in depreciation expense for each year. Accumulated depreciation reduces the amount of the asset, so it is a contra asset account, which appears on the balance sheet as a credit. On the depreciation schedule, we will increase this amount as the depreciation of the item builds each year. So in 2014, the value of the asset will decrease by $9,800, but by year 5, 2018, the accumulated depreciation should reach the total depreciable amount of $49,000. That's how simple it is to figure depreciation and to create a depreciation schedule.